Bob, Janjuah. Bob, thanks for coming in. Well, I've been away for the last 3 weeks. Yeah, everything seems to be exactly where it was before, at least the background music anyway.
No, I don't think you've missed very much. I think we've got the same issues in Europe, same issues around the US, the UK. It's all an issue around growth and the lack of it.
Yeah, as opposed to growth in this part of the world, but we've even got some concerns creeping in now here.
Yeah. No, look, I think there are issues here. I think obviously China is the big bad one that everyone's focused on, and risks around the landing. But what I find interesting actually is that the Western world seems to be looking to Asia for a way out here, which is a dramatic reversal from when I used to live here in the late 90s.
Yeah, and Bob, when we look at it, one thing when I say I've been away for 3 weeks and things haven't changed, well, equity markets have derated.
Yeah.
So I've got to ask you, what are they pricing in now?
I think they're beginning to price in what I think is a reality. Look, I ultimately think that we're in a trend-weak growth environment for the global economy for some time. I think it's going to last 2 or 3 years. In that world, I personally don't think equity markets yet are cheap enough.
Even when we're talking about the S&P, many people say it's a screaming buy right now.
Yeah, look, I mean, I think the valuation argument on equities has been something that people have been banding around in my time, the last 15 years. What I find interesting is that if you take the S&P as an example, we're trading now in nominal terms where we were 12 years ago. In real terms, equities have been an appalling investment. Certainly Western equities have been an appalling investment. Throughout that period, I've always been told that valuations are cheap. I think where we're heading to is really a world where we're going to price in a weaker earnings growth going forward, but in particular, much lower PEs, single-digit PEs.
But does it surprise you? I mean, when we look at many companies and many of these US corporates who have got so much cash on their balance sheets.
Yeah, well, that tells you all you need to know, right?
Yeah.
If the corporate sector doesn't see a useful use of its cash, why would you reward them with high PEs? I think as a safe haven, as a store of value, I can see a lot of sense in owning equities, and certainly from an income perspective, big cap equities. But from a capital appreciation perspective, Western equities, to me, it seems a bit of a stretch.
Right, so what would you be buying?
Well, look, I think a combination of things. I think right now, for me, on a one-year basis, I still think bonds are cheap. I think we're going to see 10-year yields in the US, in Germany, in the UK, in the low ones. I think high-quality...
That is really a depressing scenario that you're painting.
I think it's a realistic scenario. I don't think it's depressing. I
mean, bonds are already, what, 1.9% in 10 years?
Yeah, I think my targets, which seemed pretty aggressive before the summer, don't seem that aggressive these days. And look, it's not going to be a straight line either. We are going to have some vol. I'm pretty sure we're going to have a decent equity bounce at some point in the next 3 or 4 months. But I think the one-year view for me is bonds. I like corporate debt, high-quality corporate debt. And I do like high-quality corporate equities, non-financial.
Right.
But on an income basis rather than a capital appreciation basis.
A dividend play?
Yes.
So utilities are like that?
Yeah, utilities, pharma,
steady income, that's what you're talking
alcohol,
about.
guns, tobacco, the usual sort of suspects.
So you won't be an ethical investor then, I take it?
No. I think the other thing that people obviously are focused on is protection of sort of real wealth, and I think in that context, real assets, in particular gold, I think still has a decent amount of upside there.
Okay, well, when we look at the US economy, President Barack Obama going to be talking about perhaps a new stimulus for to try and get things going. Job creation, of course, is going to be key to a recovery there.
Yeah.
What do you expect to hear? Do you think it's going to make a difference there?
Look, I think the market's sort of expecting something on payroll taxes, possibly something on the repatriation of offshore dollars on a beneficial tax basis back into the US. I think... Personally, I think the expectations are...
Would it be in place of another round of quantitative easing?
QE3, I suspect, is still on the agenda for either very late this year or early next year. We've had the view, myself and Kevin Gaynor have had the view all year that it's probably going to take a 10% plus unemployment rate and an S&P down at 1,000 or lower before you're going to get consensus on the FOMC and in Congress to give Bernanke the kind of support he needs to push forward with QE3. I will add, though, that I don't think it will work if he goes for another round of QE3. I think what we need now...
because 2 didn't work particularly well. It just really only seemed to work in creating a bit more inflation in this part of the world.
Well, actually, that's the key problem. All 2 did was actually force Asia to slow down. So another round of QE3, which is the same as QE2, is going to force China, for example, to have to slow down even more because of the commodity inflation. The other point to make really is this, that in terms of US consumer disposable income, it got crushed as a result of QE2 because a lot of income went on food and energy. So going forward, I think QE3, which is a repeat of QE2, would actually be a negative for growth.
It's got to be, I guess, targeted differently. But I'm going to just because I haven't got much time, Bob.
Sure.
When are we going to get some clarity over Europe and the debt crisis?
Look, I think we're entering in the home stretch. I think within the next 6 months, possibly sooner, possibly as soon as the next month, I think we're going to start to see the play out, which I think is effectively a restructuring and a genuine default story. Certainly with Greece, and possibly with 2 other countries, probably with 2 other countries, and it may evolve other countries. I think the sooner they deal with Greece, the better for the rest of Europe.
But we just want clarity, don't we? That's it.
I think the market wants either full fiscal union, or
well, that's not going to happen anytime soon, is it?
Or a very clear, definitive restructuring story.
Not when you've got elections for various people, such as the big players, French President and, of course, German Chancellor coming up. They're probably not going to be making the big decisions, are they?
I mean, I think full fiscal union, even if it was politically doable, economically, just makes no sense right now. So I have a lot of sympathy with Germany. But equally, I have a lot of sympathy for Greece, and I think forcing Greece to undergo the sort of austerity that they're having to undergo, I'm not sure if it's the right thing. Just look at Iceland as an example of a way out of this.
Bob, thanks so much for your time. Bob Janjuah there, he's from Nomura